Welcome back to a brand spanking new video on the Crypto Market Updates channel. I got specs because I've been spending so much time on the computer learning, trading, evaluating crypto that it ruined my eyesight. Don't do it, kids. A while back, somebody asked me to make a video in which I would talk about risk management. So today I figured I'm gonna make a short, small video in which I will talk about 5 things you can do to manage your risk better when trading cryptocurrencies. By the way, if this is your first time to the channel, make sure to smash up the like, subscribe to the channel, and stick around till the very end of the video to see the end sign. Of course, you need to see all 5 things that you can do to mitigate your risk when trading. There are a lot of things that you need to consider before you start trading, of course, but I chose 5 things that I thought might be of the most importance, the greatest importance that any trader should keep in mind before starting to trade. So those are the things that I'm going to talk about today. Number 1 is a trading plan. Having a trading plan is a very important thing to do, and that's just includes things like thinking a little bit ahead about what it is that you want to trade and how much money you want to invest and whether to actually begin trading in the first place or not. A trading plan can help you to manage risk better, of course, because when you think about something ahead of time, it gives you the time to analyze whether you actually are able to begin trading or to do anything for that matter, and how much you are willing to risk when you do it. A trading plan could also help you improve trading consistency and eventually allow you to scale to profitability, which is of course the only reason why anybody's trading, because why would we venture out into the world of trading? Why would we cause ourselves all the headache and the stress if there was no profit margin at the end to be seen? For instance, a comprehensive trading plan strategy may include the following. Here are some things. So, what asset classes you want to trade? If you are not sure, we are talking about crypto. So in this particular video, I'll be talking about trading crypto. What setups you take, that relates to technical analysis, charts, and flag patterns that you want to look at while you trade. What tools and indicators you use, that applies to the RSI, which is relative strength index, stochastic RSI, and moving averages. And there are plenty of other indicators and tools that you can use when you are trading, when you're tracing and drawing lines in your trading view display. By the way, if you don't have a trading view account, you can follow the link below the video. I believe there is one, and set yourself up with a trading account, or rather trading view account, and check out what's up. It's free. I think if you just go into Google and type in trading view, you can have a free trading view account, and you will get, I think, maybe 2 trading view displays, charts that you will be able to display. The next thing is what triggers your entries and exits, your stop loss placement. So that's very important. A lot of traders, including myself, don't use stop losses and take profits. FTX, Armadillo. The reason for why such huge amounts of money went poof out in the air was because the CEO of Amalida, Carolyn Ellison, wasn't able to trade. She didn't know how to trade. She didn't use any stop losses and just blew all the money without any repercussions. So anyway, that's stop losses are important. And what dictates your position sizing? 1%, 2%, 5%, and 10%. I'll be talking about that in a little bit more detail in a little bit. And how you document and measure your portfolio performance, which days to trade, some details on what kinds of trading you can do, and when to do it. The advantages of trading strategy are numerous, ranging from lowering stress throughout your trading day to missing fewer trades and becoming more conscious of your trading habits, which helps you to make highly targeted development and treat trading seriously. I think a lot of people or beginning traders are jumping into trading hoping that they're going to make, huge gains within a very short amount of time. And that is a very easy way, sure way to losing your money. Wall Street has been around for decades, and experienced traders who probably know just as much as the average Joe about trading, maybe a little bit more, they never use their own money for trading. Big companies operate with millions of dollars, and they have the leverage of an advantage of, you know, how many heads they have working for them. You as an individual trader, a retail trader, are one person who needs to rely on their own understanding of how the market works and how they function as a trader. Everybody is different, and our personalities play very much into how we trade and how we behave on a platform. That's basically the entire psychology behind the market. Any experienced trader will tell you that the market is driven by human psychology, and that's why we see dips, that's why we see drops in Bitcoin, because when the market when we see inflation like right now, then everybody's withdrawing, selling their Bitcoin and taking cash out because people need it to live. And so that's very much how the markets function. So you need to be aware of your habits, of how you trade. What are the best strategies for you? Once you have a strategy in place, the next essential step is to stick to the trading strategy, especially in a losing trade. Oftentimes, people will lose their minds when you start seeing when the market turns against you, whether you're going long or short, the market turns against you. People oftentimes will begin to panic and either panic sell or if for an unfortunate reason your position is liquidated, people oftentimes will jump back in and try to recoup the losses, which is one of the worst things that you can do, because again, that is a sure way to losing money. In trading, losses are a part of a parcel of the game and are completely normal, even for the most experienced professionals. So you need to mitigate your losses. You need to be aware of how much you are willing to risk, how much you're willing to lose, and mitigate those losses, and so that it's not the entire bulk of your entire portfolio. Because as long as you have money in the game, as long as there is money in your account, you can trade. But once your position is liquidated and there's no more money in your account, then that's it. You're done. Game over. Not to mention that the financial losses that you incur in that process can be devastating mentally, psychologically, and oftentimes physically. Often we see new traders abandon their plans once they start losing trades. So like I said before, when people see their trades turn against them and the tide goes the other way, they might jump and try to recoup the trades, the losses, and basically lose a lot more than they should. So don't do that. Be aware. That's why a plan is essential. Be aware of what you're getting in and how you start, and what your perimeters are in terms of your risk acceptance, how much risk you're willing to accept, and when to take profits. That's also equally important. Don't be greedy. Whenever you panic and abandon the plan, it's likely that you will make more off-track trades, which sometimes could be good. Most of the time, they turn out to be catastrophic. Worse, you could even make more trades out of the fury to regain what is lost and eventually losing more. Again, as long as you have money in your account, you're golden. But once your money is gone, you are gone as a trader. Number 2, stop loss orders. So all of this brings us to stop loss orders. By the way, I made this presentation very fast, so I hope that aesthetically it's aesthetically pleasing and it's not conducive to a educational environment. So I hope you are learning something. I hope this is helpful. Remember to smash up the likes if it is, and stick around till the very end because it's important. So number 2, stop loss order. Number 2 step to managing your risk is placing proper stop loss orders. The fundamental concept of risk management is to reduce the risk of outsized losses. One of the common methods to minimize losses is by using a stop loss. A stop loss is an order that allows an investor to limit the possible loss on an investment by specifying a price limit over which the asset will move. So a stop loss basically depends on the amount that you're willing to lose. If you, just to give you a quick example, if you are entering a trade and let's say it's $1,000 and you presume that you're willing to risk 20% on the trade, you will place a stop loss 20% below the entry point, at which point if the trade goes in the opposite direction, the stop loss will be triggered and you would lose only 20% of your position rather than entire 100% in worst cases. And in order to because the markets are volatile and they move up and down, it's also very important to set your take profits, because you know, you don't want to be greedy. Everybody would want the 1000% gains, but those don't come immediately, and it takes some time. You need to train yourself to do that. And you know, again, decide on the percentage of profits that you're comfortable with, that you're happy with. If you make, most traders, I think, if they make 1 or 2% profits on any trade, that's a good day's trade. So you need to understand that and not be greedy. Assume you purchase 10% BNB BUSD contract on Binance futures at $350 each. To minimize the possible loss on this transaction, you could place a stop loss order at 20% below the purchase price, or $280. So if BUSD ever dumps to $280, then you'd only be losing a small percent of your entry. If the price of BNB falls below 280, your stop loss order is triggered. The exchange then sells the contract at the current market price, which may be precisely at the 280 trigger price or substantially lower depending on prevailing market conditions. If for some reason the market just dumps suddenly, oftentimes, well, I don't know oftentimes, but the stop losses can be triggered below the order. Hopefully, I think exchanges like Binance are pretty solid. By the way, if you are not registered with Binance, then make sure to follow the link below. You can register now. You get yourself a $100 bonus, registration bonus, if you make a deposit within, I think, a certain number of days. So make sure to check that out. And also you will receive a 10% discount on your trading fees. So that's a pretty good deal. Check that out. Investors use stop loss orders as part of their risk management strategy to exit positions if they don't perform as expected. Stop loss orders enable investors to make predetermined decisions to sell, which helps them avoid letting their emotions influence their investment decisions. If you are unsure of which way the market is going, and because the crypto market fluctuates up and down and it's very volatile, it can be very volatile, oftentimes you may be hesitant about whether to sell or not. And you know, I've experienced in the past, I've myself experienced times when I was hoping that the market would rebound and I wasn't certain whether I should sell or keep my position. And of course that cost me a lot more than if I had set a stop loss order and I would have, you know, cut my losses at 20% rather than whatever I lost. And you know, the losses that I incurred are significant. And so I'm speaking from experience here. Stop loss orders are also useful in times of rapid market fluctuations or unexpected crashes. So yes, as said. Number 3, money management. Never risk more than 5% of capital per trade. And of course, there are different trains of thought. The one strategy that I suggested, and I talked about it in the mock trading in the mock trading video that I have on Binance. If you are interested in setting up your very own mock trading futures account, then you can do that through Binance as well. Check out my video in the Crypto Market Updates channel, on the Crypto Market Updates channel. Check out my video on how to set up your futures mock trading account, and you can practice your trading there. And the strategy I talk about in that video is risking no more than, or investing no more than 10% of your overall portfolio, which means that if you gain or lose money, the amount of of money that you invest never exceeds 10%. And we'll dive into this a little bit more. Money management is a method for adjusting your position size to reduce risk while maximizing the growth potential of a trading account. It is a strategy to limit the capital placed on any one trade to 5% or less of the account value, never more. So again, this is 5% as an example, but again, you have to decide on your risk tolerance. I found that the 10% was good for me. It was comfortable. If 10% is too much for you, then you might want to drop it to 5%. And that works best. It gives you a peace of mind. This way you never lose more than 5% of your overall portfolio, which helps you to stay in the game. And hopefully you have learned a little bit more about how to trade. So some trades go against us, most hopefully go in our favor. So overall, if you do maintain a 5% risk tolerance, then you should be in profit in no time. Due to the unpredictability and volatility of cryptocurrencies, it is possible to lose your entire investment capital in minutes when investing in high leverage derivatives such as perpetual futures contracts. As such, investors should observe a stricter limit. The rule of thumb when it comes to trading in volatile assets is to risk only 1 to 2% of your capital in a given trade. So with this in mind, there's an example. Assume that you have 10,000 BUSD in your USDSM futures wallet. In this case, you would allocate between 100 to 200 BUSD of risk per trade. Should a trade go wrong, you would only lose 1 to 2% of capital in your account. So for example, if you have $10,000 in your account, 10% would constitute $1,000, and that's what you would be trading with. You wouldn't be trading with $2,000 or $3,000 out of the 10,000 BUSD. You would be trading with $1,000. And you might want to consider what the percentage of trades you would want to open. So if you are trading at a leverage, that allows you to enter a trade with larger positions, but only using a smaller amount of your own money. So for example, if you enter a position with you could basically open one position with $1,000 and have place a stop loss 20% below your entry point, or you could open multiple positions using no more than 1% of that initial 10% that you intend to trade with. So for $1,000, you could open, for example, 10 positions with $100 and have those run in your favor, hopefully. Or divide the 10% however you want, maybe 2% or 5%, but never more than an overall 10% of your overall portfolio. That's the strategy, that's the suggestion that I would provide. Managing your risk well means having the right position sizes, knowing how to place and move your stop losses, taking into account the risk-return ratio. Number 4, don't overtrade. Overtrading occurs when you have too many open positions or risk a disproportionate amount of capital in a single trade, exposing your entire portfolio to undue risk. To avoid overtrading, one must adhere to a trading plan and exercise discipline in sticking to the pre-planned strategy. So again, decide on the strategy, decide whether you want to go with one trade and 10%, which basically that would be overtrading, that's probably not recommended, or you want to have two trades open with smaller percentages, or maybe 2% on one trade, 2% on another, 5% on another, but don't overdo it with trades. I would stick to a maximum of 4 trades at a time within your 10% investment of the overall portfolio, because the more trades you have, the more things you need to keep track of, and the more time you need to devote to keeping track of these things, which creates a whole bunch of headaches. And especially for new investors, for new traders, I would mitigate these risks as much as possible. You don't want to overexpose yourself, you don't want to overtrade, and you don't want to get liquidated within a matter of minutes or hours. You want to stay in the game for as long as you can and learn the tricks of the trade and hopefully make profits over a longer period of time. Think of trading as a marathon. It's not a sprint, it's a marathon. The golden days, I guess, of so many say the golden days of making massive profits on bitcoins are over. If you had invested in Bitcoin in 2009 or anywhere between 2009 and 2017, you could have just been sitting on golden eggs and done nothing, and you'd have been a millionaire by now. But those days are gone. If you ever invent, or anybody ever invents, a time travel machine, that's what I'm doing. I'm going back to 2009 to get me some Bitcoin. Most new traders are notorious for overtrading, and more often than not, it is due to the failure to control emotions such as greed, fear, and excitement. Again, when you don't have a stop loss set in place, and you see a trade going against you, you're looking at possibly losing all of your money. In which case, you will try to exit the trade at a massive loss, and then when you see the market recoup, you will start reversing again, meaning that you could have had kept your trade open and you would have been fine. You might jump back into another trade, hoping to catch the wave moving up, and then boom, the trade turns against you again and continues to go down further, and you lose your pants. So don't do that. Though traders can profit massively from opening many positions, the losses can be equally devastating. A prudent approach to limit the losses from all your positions is to place a ceiling on the amount of capital you risk at any one time. Very important. If you have 25 positions in your portfolio, for example, and the amount of at risk for each position is 1%, it's conceivable, and almost anything can happen in the crypto markets, that all 25 positions will go against you at the same time and cause a major loss of 25% of your portfolio. Yeah, so limit the number of positions you have open. It's not a race. It's a marathon. In addition to risk per trade, you should also consider the cumulative amount of risk in your entire portfolio. This is also known as the total capital at risk. As a general rule, your total capital at risk should be less than 10% of your portfolio, which means if you're risking 1% of your portfolio per trade, the maximum number of open positions is 10. Number 5, the last point that I'm going to make today is only invest what you can afford to lose. This is very, very important. If you don't have money to feed your kids or pay your rent, do not take that money and invest into cryptocurrencies or any other trading strategies, and certainly not leveraged tokens or leveraged trading, because that's a sure way of losing your mind and losing more than the money that you put in. There is one golden investment rule that you should always keep in mind: never invest money that you can't afford to lose. Crypto is volatile, prices can change drastically at any time. Trade crypto futures only with excess savings. So if you have some extra money on the side and you're willing to lose it, if you lose that money, it doesn't mean that you have to remortgage your house or go doing things you don't want to do. That's the money you want to use. Basically, if you have a piggy bank in which you stuff your money and you don't use that money, that's the place you'd like to crack open and use for crypto trading. Otherwise, don't. A good trader must be willing to keep their emotions away and operate in a systematic and calculated way. In addition, ensure that you have established a robust risk and money management strategy to protect your capital at all times. Remember to always utilize the rule of thumb of risking 1 to 2% of your account balance per trade. And always brace yourself to make losses to better accept them as part of the futures trading process. There are a lot of trading strategies online that talk about 60% gains, 80% gains. That's what you're looking at. With a 60% profit margin, you are looking at a 40% loss margin, which is not great. The goal is to have no more than, to lose no more than 20% on your trade, or hopefully less, and no more than 10% of your overall portfolio. So the stricter you are with your trading, and the more patient you are, the more successful you will be. and hopefully in the long run you will find that these 5 points are helpful. If they are, then make sure to smash up the likes, subscribe to the channel, leave me a comment in the section comment below. Let me know if this was helpful, if there's anything else that you would like me to cover in upcoming videos. I know I haven't been online in some time. I've been busy. I just came back from Canada. Actually, I was visiting my hometown in first time in 15 years, but I'm back, baby, and hopefully I'll be able to make more videos. So yeah, alrighty, thank you for tuning in. I hope this was educational. Make sure to subscribe to the channel, make sure to hit that like button, and if you don't have a Binance account, then follow the link below and get yourself all the goodies and open up a mock futures trading account with Binance. Until then, have a good weekend, because it's weekend here. Alrighty, bye bye.